Welcome to Iron Financial. Look, if you're here for paper-thin promises or to just blindly ride the latest market hype, you are in the wrong place. But if you're ready to actually forge a portfolio made of absolute steel, hit that subscribe button right now. In today's explainer, we are putting the entire artificial intelligence sector right on the anvil. We're going to strike it hard, look for the fractures, and find out what is actually built to last in this market.
That's exactly right. And frankly, we need to do this today because the narrative out there, it is completely starting to decouple from reality. I'm looking at the broader market right now, and there is this massive, glaring contradiction staring us right in the face.
Here is the central question for today's drill down. Think about this. If artificial intelligence is booming, if we are supposedly right in the middle of this multi-trillion-dollar supercycle that everyone is talking about, why are major AI software stocks sliding? Why is there so much market weakness actively pulling down big tech companies despite all this relentless AI hype on every single earnings call? Is this just short-term noise, or are we looking at fundamental structural flaws in the software layer of the market? And that is exactly what we are going to unpack. Look, we are witnessing a brutal macro shift right now. For the last decade, the playbook was easy, growth at all costs. But now, the market is looking at these companies and saying, show me the money. The honeymoon phase of simply whispering the word AI into a microphone on an earnings call and watching your stocks soar 20%, that's over. Done. We've seen billions in market cap completely wiped out over the last few weeks in the software sector alone. The market is demanding execution. They want real booked revenue, and they want absolutely bulletproof margins.
So our mission for this explainer is incredibly simple. We are going to cut through the market weakness, strip away the speculative froth, and find the solid foundation. We are going to stress test the financials of the flashy software layer living up there in the clouds, and we are going to compare it directly against the heavy industrial infrastructure bedrock that is actually powering this entire revolution. We're going to see exactly who is bleeding, who is actually growing, and who is building an impenetrable market moat.
Section 1. Salesforce, the AI skyscraper. Let's get into it. In the world of enterprise software, you have to think of Salesforce as the ultimate AI skyscraper. It's massive, it's covered in shiny glass, it totally dominates the skyline. And right now, it has been aggressively pivoting to position itself as the premier AI-driven enterprise solution. But here's the thing about building a skyscraper. The higher you go, the more susceptible you are to high winds. Let's look at the raw numbers they just poured into their foundation. From a top-line perspective, I'll admit the numbers look like heavily reinforced concrete. For Q1 of fiscal year 2027, Salesforce actually delivered a revenue beat, bringing in a massive $11.13 billion. That's a very solid 13% year-over-year growth rate. On top of that, they delivered a very strong $3.88 in earnings per share. Net income rose to $2.11 billion. Beating the $3.12 consensus estimate by a massive 70 cents, that is huge. As a seasoned trader, when I look at those headline numbers, I see a company that is operating in a really tough macroeconomic environment where enterprise IT budgets are absolutely under the microscope. Squeezing out that kind of bottom-line profit shows extreme cost discipline. It tells me management knows exactly how to generate cash when the pressure is on.
Now, let's look at the agonizing detail of their artificial intelligence growth, because this is what everyone is watching. This isn't just vaporware, this is actual booked revenue. The surge in their Agentforce platform's annual recurring revenue, the ARR, is staggering. Back in Q4 of fiscal 26, it was sitting at nearly $800 million. By Q1 of fiscal 27, it hit $1.2 billion. That is a massive 169% year-over-year surge. Furthermore, when you look at their total AI product ARR, combining Agentforce and Data 360, it reached nearly $3.4 billion. Market Skeptic.
Okay, wait, hold on. Let me jump in here and act as the skeptic for a second, because I'm looking at these exact same sources. The most critical data point I see in this breakdown is that 60% of these AI-related bookings came from current clients. Now, sure, that's fantastic for cross-selling. You love to see a company monetize its pace. But does it mean they are just squeezing their existing customer base harder? Are they actually capturing net new market share, or are they just reshuffling the deck chairs on the exact same enterprise clients? And more importantly, is there a massive danger of cannibalization here? Are they essentially just trading a highly predictable human seat license for an AI subscription?
And speaking of reshuffling things, let's look at the Salesforce FY27 disclosure updates agenda. They're going over the new disclosure framework, the FY27 disclosure updates, and the FY26 disclosure recast.
That agenda brings me to my next point of skepticism. Salesforce is actively restructuring their financial reporting to highlight these exact AI numbers. Now, whenever a company completely changes how they report their metrics, we have to ask the hard question. Is this to actually provide better visibility to us investors, or is it a shiny distraction from an underlying structural weakness in their legacy core business? That's a totally fair question to ask, but let's look at the actual mechanics of this new framework. Salesforce claims this is a, quote, rigorous cadence to provide a comprehensive view of long-term value creation. They are now explicitly breaking out Agentforce apps and the Data 360 and Platform Foundation that powers it all. They want to show investors exactly where the AI money is flowing. Additionally, they adopted the ASU 2023-09 income taxes accounting changes retrospectively back in Q4 FY26. For anyone who doesn't work in an accounting department, let me give you the quick nonsense explanation on that. Basically, this rule forces companies to explicitly break out exactly where they are paying taxes and why their actual tax rate differs from the statutory rate. It essentially prevents multinational companies from hiding behind blended global tax averages. It means, as an investor, reading the balance sheet, you get a much clearer, high-integrity picture of the actual cash leaving the door to governments. So whether you personally like the restructuring or not, from a purely technical standpoint, they are providing more bottom-line clarity.
Section 2. Finding cracks in the armor. All right, more clarity is generally a good thing. But let's take that hammer and actually hit this glass facade. It's time to formally pivot this discussion and find the structural flaws. Because here is the reality. Despite that $11.13 billion revenue beat we just talked about, and despite the massive Agentforce ARR surge, the market did not reward Salesforce. Let's cross-examine the data here. If Q1 revenue beat expectations, why on earth is everyone so nervous? Well, it's all about the forward-looking blueprint. Salesforce issued Q2 revenue guidance of $11.3 billion. The problem? The broader market and the sell-side analysts were expecting a baseline of $11.4 billion. Now you might say, that's just a slight miss, what's the big deal? But the psychological impact of a guidance miss in a high-multiple stock is brutal. When you are priced for absolute perfection as a high-growth AI skyscraper, even a fraction of a percent miss on near-term guidance is a massive red flag. It signals to Wall Street that the momentum might be decelerating, and that's when investors start rushing for the exits.
Exactly. Let's break down the immediate market reaction to that slight top-line miss. The stock slid over 3% in extended trading. They set full-year fiscal 27 revenue guidance at $45.9 billion to $46.2 billion, which is roughly in line with the $46.1 billion consensus. They also raised full-year EPS guidance to a very, very healthy $14.06 to $14.12. But notice what happened here. The market completely ignored the full-year profit raise. They didn't care. They focused entirely on the soft Q2 revenue outlook. Traders are demanding absolute perfection from top to bottom right now. They don't just want to see profit margins expanding through massive cost cuts and layoffs. They want to see actual revenue expanding because the product is indispensable to the client. Salesforce showed a hairline fracture in that top-line growth, and the market punished them for it instantly.
And here are these specific bearish indicators that are widening that exact fracture. We are seeing a softer than expected revenue backlog. We have that light near-term guidance we just talked about. And we are still seeing a broader macroeconomic environment where enterprises are highly cautious about their spending. Bank of America research recently highlighted a core investor concern that we really need to talk about. What if AI is actually a growth risk for Salesforce? Think about the mechanics of AI cannibalization for a second. If one highly automated AI agent can now flawlessly do the work of 3 human customer service representatives, that enterprise client is going to fire those 3 humans. That means 3 fewer software seat licenses sold by Salesforce. So the million-dollar question is, will the premium charged for that AI agent truly offset the massive loss of volume in traditional recurring user licenses? That is the structural risk threatening the skyscraper.
Section 3. Equinix, the concrete bedrock. That is a brilliant question. If software is vulnerable to AI cannibalization, then where's the safety in this market? We need to shift our focus from the shiny software skyscraper all the way down to the heavy lifting. We're talking about Equinix. This isn't the flashy application layer. This is the physical, concrete bedrock. These are the actual data centers, the power grids, and the physical infrastructure powering the entire AI revolution. While software stocks slide on minor guidance misses, let's see how the bedrock holds up under pressure. We can lay out the chronological blueprint for Equinix's projected growth based directly on their recent 8K investor update. They are projecting incredibly stable, methodical milestones from Q1 of 2026 all the way through the full fiscal year. Unlike software companies that are highly volatile quarter to quarter, Equinix builds their financial guidance the exact same way they build their facilities: heavily engineered, structurally sound, and completely lacking in negative surprises.
Let's relentlessly drill down into this FY 2026 guidance. Total revenues are expected to range between $10.123 and $10.223 billion. That is an as-reported increase of 10 to 11% over the previous year. Adjusted EBITDA is projected between $5.141 and $5.221 billion. But most importantly, we have their adjusted funds from operations, AFO. For those of you who aren't deep in the commercial real estate weeds, Equinix operates as a REIT, a real estate investment trust. This means they own the physical properties and pass the income directly to shareholders. Because traditional accounting measures like depreciation heavily distort real estate earnings, making them look artificially low, AFO strips all that non-cash accounting noise away. It is the absolute truest measure of actual cash flow for a landlord company. It's the money actually hitting the register. And for Equinix, that AFO is expected to be a massive $4.158 to $4.238 billion. That's an 11 to 13% increase over the previous year.
Just look at the Q1 2026 projected revenues, $2.496 to $2.536 billion. That's a steady 4% quarter-over-quarter growth. This brilliantly illustrates the exact contrast we are talking about today. We just spent time talking about Salesforce getting punished for a slight guidance wobble because their growth is constantly in question. But here, Equinix is delivering highly predictable, sequential, compounding growth. This is the difference between a volatile subscription software business desperately trying to reinvent itself with AI and the physical landlords who simply collect the rent from every single server that runs those AI models. No matter who wins the software war, the landlord gets paid. The house always wins.
Section 4. Stress testing the margins. It's a great point by my co-host. But look, we don't just accept top-line growth at face value here at Iron Financial. It is time to put Equinix balance sheet right back on the anvil and stress test their profitability. Because as the old trading floor saying goes, revenue is vanity, margin is sanity, and cash flow is reality. Let's see exactly how efficiently they are turning that $10 billion of revenue into actual hard profit. This is the number that proves the structural integrity of Equinix: 51%. That is their expected adjusted EBITDA margin for the full year of 2026. We really have to remember the massive physical costs involved here. We aren't talking about writing some code and deploying it on AWS. We are talking about industrial-scale liquid cooling systems, massive local power grid connections, and prime real estate acquisitions. Extracting over 50 cents of operating profit for every single dollar of revenue in the heavy physical world, that is a testament to immense pricing power and incredible operational leverage.
And the really crucial point to take away from this is that this 51% margin represents an approximate 200 basis point expansion over the previous year. So my natural question, playing the skeptic, is this operational efficiency truly sustainable over the long haul? We all know about the rising costs of energy globally. The grid is stressed. How is Equinix shielding those margins from utility inflation? Are they passing those massive energy costs directly to the commercial tenants, or are they quietly cutting corners on facility maintenance to juice the margins for Wall Street? Or is this simply just the natural result of economies of scale as these new AI workloads demand higher density, higher margin interconnections within their existing data centers?
To answer that, we have to look directly at their capital expenditures. Equinix is projecting total CapEx between $3.655 and $4.155 billion. Now, look at the split. The overwhelming majority of that, $3.385 to $3.865 billion, is non-recurring CapEx. They are absolutely not cutting corners. They are literally doing the multi-billion-dollar heavy lifting to build the physical factories of the AI age. Meanwhile, their recurring CapEx, which is just the cost to maintain their existing fortress, is only $270 to $290 million. That ratio is staggering. That massive upfront investment creates an impenetrable market moat. Think about it. You can't just code a new Tier 4 data center over the weekend from a coffee shop like you can a software app. It takes years of local zoning approvals, massive power procurement contracts, and heavy industrial construction. That physical moat is exactly what protects their 51% margins.
And let's not forget the nuances either. No metric is left unchecked in our stress test. Equinix does operate globally across multiple continents, which means they are inherently exposed to international currency fluctuations. However, their guidance includes foreign currency benefits, an $11 million benefit to Q1 EBITDA and a $17 million benefit for the full year 2026. Now sure, it's a relatively minor tailwind in the grand scheme of a $10 billion revenue giant, but it shows that right now, even the unpredictable macroeconomic variables are actually reinforcing their concrete foundation rather than eroding it.
Section 5. The Iron Financial Verdict. All right, we have swung the hammer, we have thoroughly stress-tested the flashy AI software skyscraper, and we've hammered on the heavy data center bedrock. Now it is time for the Iron Financial Verdict. Let's take all of these data points, weld them together, and deliver a final, no-nonsense conclusion for your portfolio construction. Based on the raw financials, Equinix represents the solid bedrock opportunity. They offer highly predictable double-digit revenue growth, they are expanding to 51% margins despite high physical overhead, and they have an impenetrable infrastructure mode funded by billions in strategic capex. Like we said, they are the toll collectors of the AI boom.
On the flip side, we are officially warning that Salesforce's near-term environment acts as a potential trap for retail investors. Yes, their full-year EPS is undeniably strong, and having $3.4 billion in AI ARR is genuinely impressive, but you cannot ignore the soft revenue backlogs, the light Q2 guidance, and the looming structural threat of AI cannibalizing their traditional seat licenses. All of that makes that skyscraper look just a little bit unstable in the short term.
So we want to leave you with this direct challenge. Look closely at your own holdings today. Open up your brokerage account. Look at the PE ratios you are currently buying into. Ask yourself critically, is your portfolio built on a shiny, high-multiple facade that cracks the second forward guidance misses by a fraction of a percent? Are you paying a massive premium just for glass? Or is your portfolio built on the concrete bedrock of companies doing the actual heavy lifting, structurally expanding their margins, and generating billions in adjusted funds from operations?
Because the AI revolution isn't just about who has the smartest chatbot, it's about who actually has the durability to survive the brutal market cycles. Are you ready to forge a stronger portfolio? If you want to keep cutting through the market weakness with us, make sure you subscribe to Iron Financial right now. Until next time, keep stress testing your assumptions.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research and talk to a professional before making any moves with your money.